Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Ty. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good. Thank you. Today we're going to talk about how to find yield in a low interest environment. Unfortunately, for those savers and those looking for yield, interest rates right now are at an all-time low. Some people are speculating we would go to zero or a negative interest rate, which I don't think we've ever seen, but we are extremely low. And remember, when it comes to low interest rates, that can be a significant advantage to those people who are looking to borrow money. So if you're looking to borrow money for a home, for a mortgage, if you're looking to buy a vehicle or home equity line of credit, anything like that, while you're borrowing, interest rates are low. Low interest rates are intended to stimulate people to borrow, to stimulate the economy, to get things going. And your repayment isn't nearly as bad as it is when you have high interest rates, of course. But on the flip side, it's a double-edged sword. And when it comes to savers, unfortunately, a low interest rate environment is not very appealing. For those people who would like to save some money in cash positions or CDs or treasuries, we're at an all-time low rate now. It's almost embarrassing when you see some statements from clients and they'll show you some cash positions they have at local banks or credit unions and they're getting 0.3%. You do the math on that and it's sort of eye-opening, but low interest rates are really tough. And what that's caused is a little bit of a dilemma with those people who are retired and they're looking for yield. They're looking for interest. They're looking for a way to get that money coming in on a monthly basis from their investments or from their retirement plans or cash savings. And because yields are so low with cash positions and CDs and treasuries, many times what's happening is retirees and seniors are having to go beyond their risk tolerance in order to generate yield. So it creates a dilemma. They're uncomfortable in some of the investments they might go after because they carry some risk or more risk than they're comfortable with in order to get that yield to maintain their lifestyle. So what Tyler and I are going to talk about is, some opportunities for generating yield outside of cash positions. And remember, any of these things that we talk about, they aren't necessarily something that we recommend for everybody, but it is also a great opportunity to diversify your portfolio with a number of these items too. So, looking at places to generate yield, the first thing we're going to talk about is something that Tyler and I use an awful lot of, and that's blue chip dividend stocks. And part of the reason we look at that blue chip dividend stocks is if you look at major blue chip mega cap stocks, you typically see less variation of price through this volatility, but yet they give us some dividend yield. So we're going to talk about some of the basics there. We're going to look at value versus momentum stocks and what we should look at for a target with our dividend yield. Tyler, let's talk a little bit about some blue chip dividend stocks for yield.
Yeah, Dean, and before we get into that, we're going to be referring to the term yield a lot, and essentially yield is your income or interest from your investments expressed in the form of a percentage. So just keep that in mind where when we say yield, it's simply the income or the interest that you try and generate from your investments, oftentimes for retirees to live off of or to help supplement their Social Security and their pension. So that is what we're talking about when we're discussing the term yield. And Dean, as you had touched on, right now what we're seeing is many retirees, they're forced to take on higher risk tolerance than or higher risk in their investments than what they can tolerate oftentimes, simply because with lower interest rates that we've seen over time, we're really over the last 10 to 15 years, rates have gone substantially lower. And that means that lower rates over time equates to less interest being paid from different types of safe money or conservative type of investments. So what happens then is many people who are retired, they have to look elsewhere to try and generate that yield or interest from their investments. And one of the first places are blue chip dividend paying stocks. So now stocks, they pay a dividend. Every stock will have a dividend yield. Some have their dividend yield at 0%, which I'll touch on in just a bit here. But dividend yield for a stock is the dividend per share divided by the stock price per share. And that equation there equals what your yield is. So right now, we focus on about 2.5% to 3% dividend yield if you still want to get growth. And what we mean by that is oftentimes you hear people talk about different dividend paying stocks. And if people are talking about only dividend paying stocks, then those are typically referred to as value stocks. Now, value stocks, they're going to have a higher yield. And what that means is with a higher yield, instead of 2.5% to 3%, they might have 4-5%, and there's some that are even in the double digits. And I'll touch on that just a minute as well. But with value stocks, they're going to have a higher yield. The one downfall when it comes to value stocks is they oftentimes won't give you as much growth as some of the growth stocks or the dividend growth stocks. So value stocks, you might have something like Procter & Gamble, ExxonMobil, AT&T, oftentimes companies that have been around for a number of years over the long term, and they're established, they're mature businesses, they pay out a relatively stable, steady dividend, but oftentimes you're not going to get the stock growth from those companies. So those are ones where you're essentially just relying on the yield to give you income or to reinvest that dividend to grow the account. Whereas growth stocks are one of the other forms of stocks, and with growth stocks, they offer little to no yield. So for people who are younger, oftentimes we find that they like different types of growth stocks, but that's because they don't necessarily care about yield when they're younger. However, people who are retired, there are some retirees that we see who like to peel off a portion of their portfolio into different growth stocks. But oftentimes the best way to kind of split the difference between value and growth is something that we refer to as dividend growth or dividend growers. And that offers the best of both worlds, where you oftentimes can have a growing, the stock price itself is growing, the company is growing, but yet they also offer yield in the form of a dividend. And that's usually that sweet spot right now between 2.5% to 3% dividend yield, where you still get yield, but you get growth at the same time. And again, we're not giving any specific recommendations, but oftentimes some stocks that might fall into that category could be the likes of Microsoft, Apple, Home Depot. Those are just to name a few there, but those are stocks that you oftentimes will have growth in their stock price, but yet they also have a yield. They're established, they pay a dividend to their shareholders. And again, that's kind of the best of both worlds when it comes to blue chip dividend stocks. And right now, that's one of the top forms of yield that we see different people trying to get when they're retired, is just the dividend growing blue chip stocks right now.
Okay, and adding to that, Tyler explained real well, some of the options within the blue chip dividend stocks. But for those people who, just don't really know where to go to find, a good opportunity to put together a portfolio of these stocks, there's something called dividend aristocrats. These are companies that had an increased dividend each and every year for the last 25 years. Now, you can go in there and take a look at those stocks. It doesn't necessarily mean that it's good for your portfolio across the board, but many of them have been around a long time. Hence, they have been paying dividends on an increase for 25 years. And then there's another list called Dividend Kings. Those companies have been paying, I think, for 50 years an increasing dividend each and every year. So during this time of uncertainty in 2020, when you hear companies slashing their dividend, remember, going after the largest dividend percentage isn't always the best thing to do. Tyler brought up some examples there. Another one that comes to mind, and again, this isn't, we're not saying that this should be in your portfolio. We're not making a recommendation, but using it as an example. There is a stock out there called One Oak, and the ticker is OKE. And a good example here is people will look at it and say, my goodness, this is paying, a 10 or 11% dividend yield, which is phenomenal. That's very, very high. Well, part of the reason is the stock went from $73 or $74 all the way down to $28, $27, $26. So when the yield percentage goes up, the stock price comes down. So again, that's why we focus at about 2.5% to 3% dividend yield. Then we have sort of the best of both worlds. We have some growth opportunity, unrealized growth opportunity, and we also have a dividend paying out. So if the dividend isn't paying enough to the retiree or the investor, you can take some of the realized growth that you're also getting in that portfolio. Okay, the next one we're going to talk about is preferred stock. Preferred stock also pays out a yield, pays out a dividend. Preferred stock, like blue chip, is a stock. It is not a bond position. However, preferred stock acts a lot like a bond. It has a par value like a bond, and it can also be called by the company that issues it. So understand that preferred stock might pay out more dividend yield than a blue chip dividend stock. However, do realize that usually after 5 years or so, these companies have the ability to call it, which means you have it pulled from your portfolio. You have nothing to say about it. It's called by the company, and you have to find a replacement or move on from there. Ty, anything else about preferred stocks?
Dean, just the main thing, like you had mentioned, is that they are issued by various companies, but they do act more like bonds than they do stocks. They offer a fixed rate dividend. So yeah, they're more like bonds is how they act, but that's another form of yield that people can get right now is through preferred stock. And the one last thing that I want to touch on both preferred stock and different blue chip dividend stocks before we move on to bonds here is we mentioned yield, but like you had mentioned, Dean, you don't only want to look at the yield percentage because One Oak is the name of the company that you mentioned, but Carnival Cruise Lines is one right now too, where many people know what's going on with the cruise and just the leisure industry in general. When people aren't allowed to travel as much, those industries are really hit hard, and a lot of the cruise lines have been hit hard, really hard lately. So right now, Carnival Cruise, they have a 12% dividend yield, which is a lot higher than 2.5% to 3%. And those people who only look at the yield, they might want to go and buy Carnival Cruise. But here, the reason why Carnival has such a large yield percentage is because the stock price has fallen by 80% this year. So that's something where, again, you want to look at the overall picture, and that is where usually focusing on about that 2.5% to 3% dividend yield, if you still want to get growth, that's that sweet spot that we like. But again, blue chip dividend stocks and preferred stock right now are two of the stock places to look for yield. Blue chip dividend stocks, you're going to have an underlying stock price that fluctuates up and down. The dividend yield can move, whereas preferred stock, again, you do have that with preferred stock, you have that fixed rate dividend. So those are the two main things to know between the blue chip dividend paying stocks and the preferred stock.
Okay, before we go on to the next one, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Packerland Drive in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, the next one we're going to talk about when you're trying to find yield in this low interest rate environment are bonds. And many times we talk to investors about bonds, and we'll ask them if they know why bonds should be considered in a portfolio. It's not necessarily needed for all portfolios, but when we see a statement come in from other advisory firms, we'll ask them, what is the reason for the bonds? And most of the time, people have no idea why bonds are in their portfolio. Some might say it's for protection, and then you'll ask them how it protects the portfolio. They're not able to tell you. Very few people know that bonds are typically that income portion of a portfolio. So when especially when you have mutual funds, many times they're classified as growth and income. Growth mean equity positions, income meaning bonds. So you have a mutual fund that has a combination of both of those. So the income, when people talk about income in their portfolio, many times that's bonds. However, there are a lot of different variations here. Some of them paying out dividend yield significantly better or interest significantly better than others. So not all bonds are alike. There are short-term bonds and long-term bonds. There are everything from corporate, government, high yield, and foreign bonds. There are also bonds that are held individually or bonds that are held in mutual funds or exchange-traded funds. So we're going to talk a little bit about the difference in them and what you should be looking at when you're considering bonds for yield. So Tyler, let's talk about the difference between the bonds as far as corporate treasuries, high yield, and foreign.
So the first thing that we want to talk about when it comes to the differences between the bonds are the types of bonds. So the first one being corporate bonds is one of the more common terms that people hear of when they hear about bonds. And corporate bonds are simply bonds that are issued by large corporations or small corporations. So there's corporate bonds are viewed as relatively stable depending on the company who issues them. But those are issued by corporations or companies to fund different projects. And with corporate bonds, usually they'll pay out an interest or yield or an interest rate that is kind of in the middle. Now it often fluctuates depending upon the interest rate environment and the Federal Reserve, but oftentimes corporate bonds, their rate or their yield is going to be right in the middle of the next two that we're going to talk about. But with corporate bonds, depending on the interest rate environment, some people try and target anywhere from 2, 3, 4, 5% in yield. So corporate bonds are bonds that do offer a relatively good yield based on interest rates right now. Another bond are treasuries, which those are issued by the government, and treasuries are extremely stable, but with that comes a low yield. So oftentimes, if you have bonds that are not going to fluctuate as much, then the yield, that's the trade-off that you get, where your yield probably isn't going to be as much. So corporate bonds oftentimes have a higher yield than treasuries, but corporate bonds can fluctuate in price. Their price can fluctuate, whereas treasuries, they're oftentimes more stable. And then we also have high yield, or sometimes referred to as junk bonds. And with high yield bonds, that is more, high yield bonds actually act a little bit more like stocks, where higher yielding bonds, you can get a higher yield, but you also take on more risk because the underlying issuer is rated at junk credit, is what they call it. Basically meaning that if you were to invest in those bonds, you might be averaging 6, 7, 8, 9% per year in yield or interest, but with that higher rate, you take on the risk of the the underlying company defaulting, and then there goes your money if that were to be the case. So high yield or junk bonds are another type of bond that people go to for higher yield, but you want to be careful with those. And instead of the individual high yield bonds, we like high yield ETFs and mutual funds, which we'll get into in just a minute here. But then there's also foreign bonds, and foreign bonds are ones too that can sometimes offer a higher rate, but as the name implies, those are bonds that are issued by companies that are domiciled or established and located outside of the United States. So foreign bonds are ones where, again, you have different types of exchange rate risk and interest rate risk depending on other governments and municipalities that are outside of the U.S., but they do offer oftentimes a higher yield than some of the U.S. bonds or treasury bonds. So again, the four main types of bonds are corporate, treasuries, high yield, and foreign bonds, and the rate or the yield that you get all depends on the type and then the term, and we're going to talk about that in just a minute here too.
Okay, good points, Tyler. When it comes to bonds, also we're looking at the long-term versus short-term. So if you do carry a bond individually outside of it being in a mutual fund or an exchange-traded fund, you look at long-term bonds versus short-term bonds. You also look at whether they're corporate, treasuries, high yield, and foreign. But just as a rule of thumb, long term typically means you're going to take on more risk because you're carrying them long term. So you're going to have to go through many other economic cycles and interest rate changes and so on. However, you're typically rewarded with more of a yield. So the more risk you take on, the more yield, the better the yield is going to be for you. Short-term bonds, you typically have less risk, but you also have less yield because of the less risk to it. So with risk comes typically a higher yield when it comes to individual bonds that you're holding. Tyler, anything else that we need to knock off as far as the bonds are concerned?
No, just the main things is know the difference between the type of bonds and then, like you had mentioned, Dean, when long-term versus short-term or intermediate term. The longer the term, the higher the yield because there's more risk. If you have short-term bonds, you take on less risk, but you also do get a lower yield in return for that less risk. And then lastly is that we often find it better to use bond funds or ETFs because you can buy and sell easily and you don't have to worry about the bond being called. Whereas individual bonds, you buy into it and then you have to worry about it being called, or you have to hold it until the term length of the bond. Whereas bond mutual funds or ETFs, they trade just like stock mutual funds or stocks, where you can buy and sell throughout the course of the market, and you have less risk and you're diversified. Basically meaning that a bond fund is a basket of a whole bunch of individual bonds into one, which offers you less risk than only one individual bond, and it offers more diversification, where if you do have one or two of the issuing companies or governments or foreign bonds, if you only hold individual ones and they default, well, then you're out of luck. But having a bond fund, you have so many different individual bonds within it that it allows you for less risk and more diversification. And again, it's important to note that diversification does not protect from loss or guarantee a profit, but it is something that we use to manage risk over the long term. And oftentimes by using bond funds or ETFs, we can do that.
Okay, good points, Tyler. The next thing we're going to talk about when we're looking to find yield in a low interest environment is real estate investment trusts, or as some people know them as REITs. Many people cannot afford real estate, but yet would like to be involved somehow with real estate for diversification within their portfolio. Now, realize that real estate investment trusts are still in the stock market. It is something that's driven. There's based on the market. There is volatility, and they're also interest rate sensitive. But when it comes to real estate investment trusts, if you don't have enough money to go out and buy yourself a rental unit and get tenants in there and collect money on a monthly basis, you can instead go to the market and pick up real estate investment trusts. What they are companies that invest usually in properties. So you can get some real estate investment trusts that invest only in retail storefronts or malls. They own the mall and then they lease it out to companies. They collect the money that way and they share with you if you buy into their real estate investment trust. So it pays usually a more significant yield typically than stocks do. Other types of real estate investment trusts, for instance, people are looking at the 5G opportunities here that are upon us, and there are companies that own towers that 5G companies tap into. So you look around the country and you see these towers showing up all over the place, cell towers. Many of those are not owned by the companies individually. AT&T might not own them, or Verizon might not own them. Who owns them is, American Tower owns them. It's a real estate investment trust, and then they lease those out to the telephone companies. So real estate investment trust can be a lot of different types of properties. It gives you an opportunity to diversify a bit within your portfolio, and it gives you an opportunity to buy in as a shareholder into some real estate options without you physically having to go down and get a mortgage at the bank.
Yeah, Dean, really good points there. But when it comes to finding yield in a low interest rate environment, REITs or real estate investment trusts are becoming extremely popular. And one of the best options to look for yield or interest right now, with rates being so low, and it's simpler, or real estate investment trusts are easier if you don't want to go and buy physical real estate and be a property manager and have tenants and be a landlord. you can easily participate in real estate and get yield that way. Some real estate investment trusts offer anywhere from 5 to 10% yield per year, which is really nice right now compared to what people are getting in their CDs, savings, or money market accounts. So real estate investment trusts are really good for income. But then in addition to that, right now one of the best places is actually physical real estate as well. But with that, with real estate, as many people know, if someone were to buy a duplex and then rent it out, you get passive income that comes in where you can get a very high yield from that. But that also has its downfalls too, where you have to be, a landlord. You have to have tenants, and you have to deal with that as well if you're going to go the physical real estate route for income. But real estate investment trusts and physical real estate are two of the best right now for those who don't want to go out and actually buy real estate, because that is quite the task in and of itself. Real estate investment trusts are very good for income right now.
Okay, adding one other thing to real estate investment trusts and real estate, we're talking about acronyms or abbreviations for REIT. There's also UIT, a UT, or a unit investment trust. What that is it's basically an unmanaged gathering, a bunch of investments that are put together. You buy this chunk of investments, and it's held for a certain period of time, 5 or 10 years. And the investments that are in there are the investments that are in there, but it's typically built around generating a higher than average dividend yield. So that's another opportunity. Okay, and the last one we're going to talk about today is annuities. Annuities are probably the most maligned retirement plan option out there. And part of the reason is there's just so much misconception about them. But when you break it down and look at it, an annuity is typically something that's put out by an insurance company. And that insurance company, the strength of that insurance company is what bases the financial strength of the annuity. So always remember, when you're buying an annuity, it's based on the financial strength of the issuing company. Okay. However, annuities are typically set up to generate a fixed income stream or a fixed rate of return if it's a fixed annuity or an indexed annuity. Understand there's a third type, which is a variable annuity, and that is based on the stock market. But all of them can generate a yield. Just make sure that you ask your advisor, if they're good for your portfolio, and the difference between the fixed, the index, and the variable.
Yeah, good point there, Dean. Annuities are the last one, the last type of investment where you can find yield in a low interest rate environment. But that should be all the time that we have for today, and we hope that you'll join us again next week.
See you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them on Packerland Drive in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.